Hey, Econ students, Mr. Ling here with your Unit 5 review session. Let's jump right into it. All right, so this is based off of taking a close look at the test and what you're going to be assessed on and trying to emphasize the things that you should really get to know. All right, here we go. So the first thing that you need to know is aggregate demand. There's not many questions about this, maybe one or two, but basically know that aggregate demand is downward sloping here for a reason. It's downward sloping because of three different effects, and you should know what all three of these are. The first is the real balances effect, or the wealth effect. So in all of these, we're showing an inverse relationship between the quantity aggregate demanded and the price level, right? So for example, when price level goes down, the quantity of aggregate demanded goes up. When price level goes up, the quantity of aggregate demanded goes down, right? So that's the inverse relationship that creates this downward sloping aggregate demand curve. None of that's new to you. You've done that since Unit 3 when we did demand and supply. But the reason for that is a little bit different because we're dealing with an aggregate here. So first is a real balances effect. This is the idea that when price level falls, that we are all a little bit more wealthy, right? The savings that we have in the bank account, all of the assets that we have now are more valuable than they were before. When our assets are more valuable, we demand more. So price level falls, the quantity we demand goes up. And vice versa. When price level goes up, we're all poorer. All the savings that I have in the account, all of my assets are now worth less as a result of that increased price level or as a result of that inflation. And so as prices rise, the quantity we demand of the aggregate of all the goods produced in our society goes down. Okay, next up is the interest rate effect. Interest rate effect is, I think, the easiest way to remember this is to think of money and the demand for money, right? Because interest rates really are just the price of money. So if the demand for money goes up, the price of money or the interest rate will go up. Right? So in this case, the price level is rising. When price level rises, it means I need more money to make the same purchases, right? So if I have a $5 bill and I used to be able to buy a cheeseburger for $5, inflation goes up, cheeseburgers are now 10 bucks, right? Prices have risen. I only have $5. I demand more money to make up that difference so I can still buy my cheeseburger. That's the idea. Okay, so when that happens, I demand more money. When I demand more money, the interest rates, that's important here, the interest rates here rise. When the interest rates go up, then the quantity I demand goes down, right? Because interest rates impact loans. I'm less likely to take out a loan to buy a house. I'm less likely to take out a loan to buy a car. But probably more importantly, businesses are less likely to take out a loan to make a major equipment purchase or build a new warehouse or start a second part of their business, right? And so aggregate demand falls because of that. It's an interest rate effect. Then finally is a foreign purchases effect. The idea is when the price level rises, those prices follow the goods that we ship overseas. So they're going to be seen as relatively more expensive in those other nations. And so those other nations are not going to buy as much. Aggregate demand, one of the four elements is net exports. And so those net exports are going to fall because the price level is higher. So they buy fewer of our goods and vice versa. When price level falls, the prices are lower for all of our goods. And that price follows them overseas into those foreign markets. And foreign nations are more likely to buy those goods and services at that lower price. So when price level falls, the aggregate demand rises. So all three of those are the reasons why it's downward sloping. Make sure you know them. You should be in good shape. Just logically, you need to know them. You won't have to work anything out for them. But there might be a question where you're asked that. All right, next up, the shifters. You really need to know these. There are several questions, maybe 5 or 6 questions where you need to know the aggregate demand shifters. So what's shifting demand and then what happens when demand is shifted, all right? So first we have consumption. Consumption, right? This is the consumers of our economy have changed the amount that they are demanding, right? So that's the first thing. So one thing that can happen is there's an increase in disposable income, right? Disposable income is simply your income minus your taxes. So if there are fewer taxes, you have more disposable income, all other things constant, right? So when you have more disposable income, let me grab my pen here. More disposable income means that my aggregate demand is going to shift right, all other things constant, because all people in our economy buy more goods and services. So I flip that over, call this AD2. I've got a new equilibrium here. and then I dash that over. Ooh, and then I get my new price level, I'll call this PL2. And I dash down, and I get my new GDP, I call this Q2. So when aggregate demand shifted right, I showed that rightward shift, it gave me a new equilibrium point right here at the intersection of my aggregate demand and aggregate supply. It gave me an increase in price level and gave me an increase in GDP, right? So that's consumption. Also, my consumer expectations can change this. If we believe that the economy is about to be wrecked, then we're going to reduce our spending because we're worried that we're going to lose our jobs. Or if we believe that the future is bright and the economy is booming, then we're going to buy more goods and services because we're confident in our jobs. Okay, so that will impact aggregate demand as a whole. Next up, we have investment. Investment. So for investment right here, we're talking about the demand of businesses. What can change how much businesses demand? And there are two sides to this. There's the expected rate of return, and there's the real interest rate. Whenever a business is deciding to invest, they're deciding based on how much money they think they can make off of this in the future versus how much it's going to cost them to take out the loan to make that purchase, right? To buy that equipment or to put that new warehouse in. Right? And as long as the expected rate of return or the money I'm going to make off of this is higher than the amount that I have to pay or the real interest rate, then that is a go. I'm going to invest. Right? So what can change the amount I invest? One of two things. It can be a change in the expected rate of returns, or it can be a change in the real interest rate. If businesses look into the future and they say, hey, the future is bright, I expect to make higher returns, my expected rate of returns are higher, all other things constant, investment's going to rise. That's part of our Sig-Jigsaw. When investment rises, aggregate demand shifts to the right, causing an increase in price level and an increase in GDP. Or they could look into the future and say, hey, this looks bad. I expect people to buy less of our goods because of the future projections, right? So expected rates of return are lower as a result of that. And so they're worried about that. And as a result, they invest less. I'm less likely to make a major purchase as a business, a multi-million-dollar investment in a new warehouse, if I believe that there's a recession on the horizon. Expected rate of return falls. When expected rate of return falls, I'm less likely to invest. And so aggregate demand will shift left. Let me show you a leftward shift here real quick. So aggregate demand shifting left looks something like this, right? We're shifting it to the left. I'm going to put AD2. We have a new equilibrium right here at my new intersection. I dash over, and that's going to give me my new price level, so PL3. So price level has fallen. We show that with a downward arrow. And then I dash down, and that gives me my GDP, Q3. GDP has fallen, right? In other words, when aggregate demand shifts to the left, all other things constantly fall into a recession. Okay, keep in mind real interest rates can change as well, right? And we'll talk later on how they do that, but the government and the Federal Reserve can change real interest rates depending on what they're trying to do. Also, the borrowing habits of people can change the interest rates. If the interest rates go up, I'm less likely to invest because that's the cost of investing. If interest rates go down, more likely to invest. Again, the cost of investing goes down. And then, of course, business taxes. If business taxes are reduced, businesses are bullish on the future and they're going to increase their spending. And vice versa. If the business taxes go up, it's going to shift it to the left. So keep that in mind. That's important, that taxes note. Right? Because taxes for consumers and taxes for businesses are two different elements that can actually affect aggregate demand. All right, next up, government spending. The only really important thing you need to know here is it's government spending without a change in taxes, right? Because we want in the case where we're looking at how it affects aggregate demand, if I increase government spending, but I also increase taxes, government spending is going to shift aggregate demand to the right, taxes are going to shift aggregate demand to the left, and so both of those things are causing an issue, right? They're offsetting one another, and so we're not going to see any real shift. So it needs to be deficit spending, spending money that they don't have, or in other words, an increase in government spending without changing taxes, or a decrease in government spending without changing taxes is more likely to shift it. Right? And it's a direct relationship. If government spending goes up, aggregate demand shifts right. If it goes down, aggregate demand shifts left. All right, final one is net exports. Net exports right here. So first, we're looking at a change in the GDP of a trading partner. If the trading partner is in a recession, they're less likely to buy our exports. So net exports falls, our demand shifts left, right? If they're doing well, if other economies are booming, then they're more likely to buy our assets. Aggregate demand shifts right because our net exports are rising, right? All of SIG-Jixon has a direct relationship with aggregate demand. If consumption, investment, government spending, or net exports are going up, aggregate demand shifting right. If consumption, investment, government spending, or net exports are going down, aggregate demand is shifting to the left. Okay. And then the final one is depreciation. This is one of the toughest ones, right? If the American dollar is depreciating, then that means that our goods and services look less expensive abroad, right? You can think of it right now, because we'll change this thinking a little bit later when we have more complexity for economic knowledge. But right now, you can just think of it as the price is dropping for our goods in foreign markets, right? If the dollar depreciates, it's less valuable. That means the price of it in foreign markets is lower, and so there's more likely going to be an increase in net exports. Increase in net exports shifts aggregate demand to the right. Okay, and vice versa. If the dollar is appreciating in value relative to another nation's currency, that means it's more valuable, which means the prices of our goods are going to go up. When the prices of our goods go up, net exports falls, and aggregate demand shifts left, all other things constant. Hope that makes some sense. Again, quite a few questions on aggregate demand shifters. That's kind of the go-to on this test. All right, let's keep rolling. Aggregate supply. Okay, aggregate supply, 3-time horizons. Very important that you know the 3-time horizons. It's not just one, it's 3 different curves. In the first time horizon, we call the immediate short run. Sorry, I just completely blocked that out. The immediate short run. Immediate short run is in a very limited amount of time. And in this time, both our output costs or prices, the price I charge consumers, are fixed. Remember, we're looking at supply. So this is from the perspective of businesses, right? So the price I'm charging firms is fixed. The price I am paying my workers, that's the input prices, are also fixed, right? So I'm not going to change the amount I pay my workers, and I'm not going to change the amount I charge my customers. In that limited amount of time, price is fixed, right? How do we show a fixed price in the immediate short run? We don't change the price no matter what's happening. So price is fixed. It's a completely horizontal curve, similar to a price ceiling or a price floor, right? And that means that any change that's going to happen is going to happen from aggregate demand, and it's simply going to impact real GDP in the immediate short run. So any change in aggregate demand will change our real GDP. All that to say, know that input and output prices are fixed in the immediate short run. You can't charge one customer one price and the very next customer a different price. You have to fix those for the same product. Immediate short run. Next up is the short run. The short run has flexible output prices. So I can change the price I'm charging people, but fix input prices. I'm not changing the price I pay my workers. So if I can change, if inflation's happening, price level is rising like it is right here, price level is going up, right? If price level is rising, I can increase the amount I charge people. So my revenues are going to rise. But I'm not changing the amount I pay to produce the product. So my input prices are fixed. That means revenues are rising. Costs remain the same. Revenue minus cost is profit. So if revenues are rising, cost is remaining the same, my profits are going up. When profits go up, businesses produce more, right? So that's why we have this direct relationship. Price level rises, GDP rises. It's an upward sloping curve, a direct relation between price level and aggregate supply. Finally, we have long-run aggregate supply. In the long run, both my input and my output prices are flexible, right? So I change the amount I'm paying people to do the job. The wages that I'm paying them is changing, right? Over time, we can change wages on a long enough timeline. And the amount that people are paying, the price I put on my product is also changing. If both of those things are variable, then price level is infinitely changing, right? So that means right here, no matter what change in price level happens, GDP remains the same, right? So it's a vertical line. It's important to note that that vertical line, this quantity right here, that is full employment quantity. That's where I want to be, right? Because on a long enough timeline, all the incentives are in place for us to produce at full employment, meaning price level will change, and it will. Price level normally going up over time, but our GDP will remain the same unless we have some economic growth occurring. Okay, I hope that makes some sense. Let's keep rolling. Here we go. All right, so let's look at the logic of the long run, right? Why does this LRAS always end up at full employment GDP? Right, so the first thing that you have to understand is that there are two possibilities here outside of full employment. We can have an inflationary situation happening where we're overproducing, or we can have a recessionary situation where we're underproducing. And both of them in the long enough timeline will adjust to get back to full employment. And you should know this logic. There's not really a direct question. I won't have this line of logic with one of them missing and say, what's this? But if you know this line of logic, you're going to do a really good job in understanding why LRAS is there and how things will adjust in the long run. Okay, so let's say we overproduce. In the event that our businesses, plural, right, because this is aggregate, are overproducing, producing beyond our capacity. Right? So our equilibrium is somewhere over here. Our GDP is higher than full employment GDP. What's going to happen is all these businesses are going to bid up the prices. When prices of the resources, so there's only so much land, so they're going to fight over that land and bid up the price. There's only so much labor, they're going to fight over that labor and bid up the price because all the businesses are doing well. They're all trying to expand at the same time, which bids up the prices of resources. When the resource price goes up, costs are rising for businesses. When costs rise for businesses, they reduce the amount that they produce back to full employment. So when we overproduce, it eventually raises the price level of the inputs, which we just talked about being flexible in the long run. When those price level increases for them, then that cost reduces the amount that we produce, getting us back to full employment, right? Then if we underproduce, we're in a recession, right? We underproduce, eventually fewer businesses are producing goods and services. So the demand for labor, the demand for aluminum, oil, all the resources, land, is down. When the demand for things are down, the prices go down as well. When the price of my resources goes down, my costs are reduced. When costs are reduced, I increase production because I'm more profitable. Production rises until we get back to full employment. So that's the logic of this. In the long run, eventually those input costs are going to change, and that change in input costs is going to get us back to full employment. So that's why in the long run, we have a vertical line at full employment, and it works as kind of our beacon, right? That's where we always want to be. Okay, what are the shifters of aggregate supply? We have three main shifters. We have the resource price, we have the actions of the government, and we have productivity. So RAP or RAP are three things that can shift aggregate supply. Definitely know these. Oftentimes you'll be given something and you'll have to know if it's aggregate demand or aggregate supply shifting. So knowing all seven of these factors, the 3 for aggregate supply and the 4 for aggregate demand, is good for you. All right, so the first one is resource prices. We talked a little bit about that already, but resource prices, if resource prices increase, it's bad for the business. Costs are rising. So if it's bad for the business, then aggregate supply is going to shift to the left. Resource prices are going up. It's more costly to do business. Aggregate supply shifts left. So we show that like this, right? We have our new aggregate supply 2. We put in our new equilibrium here. Ooh, sorry, I'm not very good at mousing today. We dash over, and that gives us our price level. So PL2. So price level has gone up as a result of a decrease in aggregate supply. And that should sound familiar to you because in the product market, exact same thing. We dash down, and that gives us a new quantity, and we should see that quantity went down, right, from QY to Q2. So when quantities reduce, that means I'm in a recession. GDP is falling. So aggregate supply shifts left, it increases price level and decreases GDP. We actually have a term for that. We call that stagflation, right? That's resource prices will have that effect if they're increasing. Right? And a lot of things can change the input price. it'll always be a universal resource. So if there's something specific about it, right, like I said, the plastic for making water coolers, for example, specific, it's a trick question. I'm trying to see if you understand that we're dealing with aggregates here. It has to be something that's going to impact the entire economy, not just that. So normally the go-tos are like oil, steel, aluminum, labor, land. Those are the main resources that we're going to be looking at, where a price change in any of those is going to cause a significant shift in aggregate supply. Okay? If I expect inflation, this is a tricky one. If the businesses all expect inflation in the future, this means that their wages are going to rise today, right? Because as I start these negotiations with my workers, I'm going to have to give them a raise to accommodate for that expected inflation, right? Because it's predicted. I know it's going to happen. And so if I expect inflation, my resource prices are going to rise, right? And if I expect deflation, my resource prices are going to reduce. There's that inverse relationship with price. So if input prices are rising, our supply is falling or shifting to the left. Okay? Hope that makes some sense there. But that's the toughest one, is that expected inflation. So keep that in mind. If they expect inflation, that's a key word to say, oh yeah, this is going to impact resource prices. Actions of the government. This is pretty basic, right? If the government adds regulation, we say it costs to comply, which means that even if I have to fill out additional paperwork, that costs me more money than it costs to not fill out paperwork, right? And so if costs are rising, our supply is shifting left. If the government decides to deregulate, we're taking away regulations that used to cost businesses money, well, those costs become revenue now, right? I don't have to pay to comply to these regulations. So let's show you what happens to our supply when we have a deregulation. Right? So our supply is shifting rightward. So we draw on our two arrows, put in our new average supply. We call this A, S, and we'll call it 3. I have a new equilibrium right here at my current aggregate demand and aggregate supply. I dash over. And as I'm dashing, this is going to give me a new price level. So we'll call this PL3. And notice that price level just fell, right? Significantly. Price level fell. And then GDP rose, Q3. So when our supply shifts right, price level falls, GDP rises, all other things constant, right? So our supply going right is actually a really, really good thing. We'll talk later on about supply side economics. And that's where they're saying, hey, this is all we should be trying to do, is shift our supply to the right, because it has two desirable effects: price levels falling and GDP is rising. Right? So that's what can happen with deregulation. You can do this with a subsidy. If I'm just giving businesses money, they're all going to be more profitable, or taxes. If I'm reducing business taxes, that can shift aggregate supply to the right. Okay, productivity. Productivity is a little more complex, right? Because productivity, let me get out of this here. Productivity impacts in those two ways still, but you have to be able to calculate productivity. Productivity is simply your output divided by your input, right? So if I have, to use arbitrary numbers, if I have 10 units of output and I have 2 units of input, right? So this is my out, O. This is my input, I. Then 10 output divided by 2 input means my productivity number is 5. Now, there are 2 ways to increase productivity. I can increase productivity by either increasing the amount I'm producing with the same input. So I still have 2 inputs, but let's say I have 20 outputs. I'm more productive. My productivity is up to 10. Or by reducing the amount of inputs. If I have fewer inputs, even if my outputs are the same, if I'm down to 1 input now, then my productivity is up to 10, right? So when productivity changes, it means that businesses are more profitable or less profitable. If we're more productive, we're more profitable. Less productive, less profitable, right? So a change in productivity, normally for the positive, will shift aggregate supply to the right. If a productivity goes down for some reason, it'll shift aggregate supply to the left. But most of the time, productivity is moving in one direction, and that's forward. All right, hopefully that was helpful. Let's keep rolling. All right. Now, the ADES model. Do you understand how to shift these and show gaps? That's the important thing here. Let me pause this real quick because I need to grab a real mice. Okay, so we're back. That probably was like a half a second for you, but it was like 45 seconds for me. So dealing with the ADES model here. So first, we're going to look for this triple intersection equilibrium, right? Our economy is at full employment when aggregate demand and aggregate supply, which indicates where our economy is, equilibrium in between those two things, is currently at LRAS, right? We call that the triple or super equilibrium, right? Right where we want to be. Because at this point, we know long-run aggregate supply indicates full employment. So we're at this triple intersection. We're at QF, full employment GDP. We're also at the natural rate of unemployment, which we say is between 4 and 5% for the most case, right? So that's what's going on there. We're full employment if we're at the triple intersection. That's where we always want to be. So if we fall away from that, either in an inflationary way or a recessionary way, then we want to get back there. Okay? So what happens? How do we show a recessionary gap? So let's do it here. So we have two recessionary gaps. I can show this by shifting aggregate supply to the right or to the left, sorry, or I can show this by shifting aggregate demand to the right. Those are my two ways to do it. So let's do aggregate demand to the left because it's more possible. So aggregate demand is going left. One of four reasons: a reduction in consumption, investment, government spending, or net exports is causing this. I pop in my new aggregate demand curve. I call this AD2. And now I have a new equilibrium. It's not right here. It is now here at the intersection of aggregate demand and aggregate supply. I dash over. My price level has fallen. We call this PL2. Price level went down. And I dash down. My GDP has fallen as well. Right? So we call this difference between where my current GDP is and where I want to be, we call that a gap. In fact, we call it the recessionary gap, or RG for short. That's the gap we want to get rid of. We do not like this gap. It's bad for our economy, right? A recessionary gap is simply a difference between our two GDPs. So aggregate supply will do the same thing. Even though a shift left in aggregate supply results in an increase in the price level, it still results in a decrease in GDP. So my current GDP is going to be less than my potential GDP or my full employment GDP, where I want to be. Right? So we're in a recessionary gap, and we're going to want to try to correct for that in the future. Okay, so that's a recessionary gap. Current GDP is less than full employment GDP. All right, let's try the next one. How do we show an inflationary gap? Well, our aggregate demand, there's only one way to show it, aggregate demand shifting to the right. So we call this AD2. When aggregate demand shifts to the right, we have a new equilibrium where AD and AS are intersecting, right? And that's always where we're at. Our economy is always where AD and AS intersect. I have a new price level, and we should see that we have inflation, right? Price level has risen. We dash down, and we have a new GDP, Q2. Our GDP is beyond where I want to be because it's gone up. The difference between these two, my current GDP at Q2 and where I want to be at QY, is called the inflationary gap, or IG. That's our inflationary gap. Okay, now this is bad. Even though GDP is rising, it has a danger of causing astronomical price level increases and destroying our entire economy. So in that instance, we want to contract our economy. We want to fix this to try and get back to full employment GDP. All right. Now, what about stagflation? So let's show you that. Stagflation is always because aggregate supply is shifting left. One of three reasons aggregate supply shifts: either a change in resource price, a change in actions of the government, or a change in productivity. So in this case, it would be an increase in resource price. Deregulation, new regulation, or an increase in taxes on the businesses, or a decrease in productivity, causing aggregate supply, causing aggregate supply to shift left. So I call this AS2. And my new equilibrium here, I show that price level has gone up. So we'll call this PL2. There's an upward arrow. And then I dash down, and I show that quantity has fallen. GDP has fallen, right? So now, if my GDP is less than my current GDP, what do I have? Inflationary or recessionary gap? Recessionary. So I call that RG. But notice at the same time, I have inflation happening. So because my current GDP is less than where I want to be, it's a recession for sure. But at the same time inflation is happening, this is worst case scenario, right? Not only are people losing their jobs, but the cost of living is rising at the same time. It's bad, Bad. We call that stagflation. Okay, hopefully those two things make sense. We also call this cost push inflation. It's costs that are moving aggregate supply to the left, right? Whereas when demand's going to the right, we have an inflationary gap. That's demand pull inflation. Okay, just keep those in mind. All right, let's roll. Our final slide, the long run adjustment. I will say that on the FRQ, you will have to make this adjustment in the long run. So I'll show you two, one where we're in an inflationary gap, one where we're in a recessionary gap. But there's also right here the line of logic. And if you know that line of logic, you're going to be able to figure this out no matter what. Key takeaway is, if you leave it alone, supply takes it home. Always, always, always. All right, here we go. So, get my marker up here. Let's say that we're dealing with an inflationary gap first. So we know that aggregate demand shifted to the right. So we'll call this AD2. We know we have a new equilibrium. We know that our current GDP is beyond where we want to be, right? We know that we have a high price level, right? So inflation is occurring, and we have an inflationary gap, which is the difference between these two quantities. That's where we're at so far. Okay. Now, we know that's what's going to happen in the short run, but what's going to happen in the long run? What's going to happen is all these businesses are overproducing, producing more than they're actually capable of doing. All businesses are profitable. All businesses are expanding. So they're competing for resources. They're competing for limited land, competing for limited labor, competing for labor inputs like oil and steel. So the price of all of those things is going to go up because more businesses are demanding them. When the price of resources go up, that's the R of our RAP, resource price. We know that resource prices increasing is going to cause a shift in aggregate supply. In what direction? Well, if resource prices are going up, that's bad for businesses, right? Costs more to do business. So aggregate supply is actually going to shift to the left. When aggregate supply shifts to the left, it's going to keep on shifting until we're back to make a really big equilibrium here. We're back at the triple intersection, right? So in other words, in the long run, aggregate supply is going to shift to fix our economy, get us back to full employment. If you leave it alone, supply takes it home. Okay, so that's inflationary gap, that line of logic right here. Demand for resources up, resource prices rise, aggregate supply shifts left as a result of that shift. All right, let's try a recession. Get back to my red marker here. Let's use aggregate demand shifting to the left. So we got AD2 here. When aggregate demand shifts to the left, we have a new equilibrium right here where AD and AS intersect. We dash over, our price level has fallen, 2, right? And our GDP has fallen, Q2. And the gap between where I am currently, Q2, and where I want to be, QY, is my recessionary gap. Now, what's going to happen in the long run? Well, businesses are not producing as much. So their demand for land, their demand for labor, their demand for all the inputs like steel and oil, all of that is going to fall. They demand less to produce. When the demand for those things falls, the price of those things falls. I'm going to be able to pay lower wages. I'm going to be able to pay less for land. When the costs or the price of resources fall, that's the R of our RAP, right? Resource price. When they fall, businesses are more profitable. When businesses are more profitable, of course, that means that aggregate supply is going to shift. In what direction? Well, more profitable means it's shifting to the right. So AS is going to shift to the right. Ooh, that's a bad aggregate supply curve, but you got the drift. Until we hit our new triple equilibrium, right? In other words, when we leave it alone, supply takes it home. It'll shift right until we get back to full employment GDP. We call this the self-correcting economy. Okay, so that's the toughest it gets. Now, what about long-term economic growth? How do we show that? Long-term economic growth normally is shown with an increase in investment, right? So let's say investment goes up. What's going to shift if we're buying more capital goods? Well, investment is one of the 4 elements of GDP. It's also a demand element. So aggregate demand is going to shift to the right. So I have AD2. But that's not all. The secondary shift is, hey, now we have more capital goods. We're going to be more productive. We're more productive. What changes? Well, that's aggregate supply. So aggregate supply is going to shift to the right. Now, both aggregate supply and aggregate demand have shifted right. What's going on there? Well, I've actually created economic growth. How do we show economic growth? We show that with a rightward shift in long-run aggregate supply, all LRAS 2. So now I have a new triple equilibrium, right, to the right of where I was. Notice what happened with prices. Prices remain stable, relatively stable, but the quantity of full, or QY2, is now up. That's how we demonstrate economic growth. Aggregate demand shifts right first with investment. That leads to an increase in aggregate supply because we're more productive. And when both aggregate supply and aggregate demand have shifted right, our price level stable, we are now producing at a new full employment GDP, right? We can show that same thing in our production possibilities curve. Increase in technology can cause something like this, right? An increase in the quantity or quality of resources can cause a change like this, right? And we'll see an outward shift in our production possibilities curve for those three factors. Those same three things will also shift long-run aggregate supply to the right. So it's nothing new. Change in technology, or the quantity or quality of resources, or capital stock. That's the quantity of that resource will shift everything to the right. So we have a new triple intersection at a quantity full employment GDP that is higher than it was before. That is how we show economic growth. That's everything. What do you have to know? Really know your shifters. Know the nuances of short run, immediate short run, long run aggregate supply. Know the reason aggregate demand is downward sloping. And then know how we adjust in the long run to these changes in GDP. You also will want to be able to draw a graph, triple intersection ADES model. It starts at full employment, moves to recession or inflation, label the gap, and then show the long-run adjustment where average supply takes us back to full employment GDP. If you do all those things, you're going to be in really good shape. All right, I hope this was helpful. Good luck tomorrow.